Mokama Sunday service. Today we are going to be talking about the top 6 reasons to enter a trade. Because Angelo asked me last week, like, what are my rules for entering? So, mostly we're going to focus on entering an investment versus a trade, meaning something that's a little bit more long term rather than the short term stuff. But some of these ideas kind of cross over. So uh, you'll get some of the short term strategy stuff and the long term strategy. So with that being said, for the YouTubers out there, this is for informational purposes only. Investing is risky. I am not a financial professional. You should address all of your trades and investments with your financial professionals or in conjunction with your financial professionals and do independent research on anything that's said in this video and podcast. All right, so let me share my screen. Bam. See, I've been getting a little bit more professional for y'all,
I
treating y'all a
see
little
you.
better, putting a little bit more time into the presentation. So, top 6 reasons to enter a trade. Once again, this isn't a reason, but always in the back of your head, you should be saying, is this an investment or a trade? An investment is longer term. Is this something you want to hold for months, years, 5 years, 10 years? Those are investments typically. Trades are shorter term. Or am I going to hold this for the day, for a few hours, for a few minutes, for a couple of weeks, a couple of months, those for a longer term swing? But that's essentially a trade. When I'm talking about trading, I'm talking about scalping, day trading, swing trading. Investing is something that's like on a longer term time frame, at least a leap and onward, in terms of holding things for 5 to 10 years or longer, right? So, my number one reason to enter a trade, is it discounted? I always want something that's discounted. I'm never going to buy anything at an all-time high. In the words of Warren Buffett and Charlie Munger, you're looking for great companies at a reasonable valuation. So the way that I figure out if a stock is discounted is by drawing Fibonacci retracements. So we've gone over this before. Here, my standard example is Apple. Here are the fib levels on Apple, right? And essentially, these retracement levels, I'll do it on a 5 year month chart. If you want to change your chart in Thinkorswim, you just come to this tab here, change the time frame here to whatever you want it to be, right? And the interval and the aggregation period is essentially these candles here, right? Each candle represents a month because that's our aggregation period. And this chart represents the last 5 years of Apple's price movement. So I'm drawing the fib levels to determine what is the all-time high. Here we can see the all-time high on Apple is $220.20. So that's where your 100% is going to go. And then the 5 year low on Apple is $48.15. Right. So essentially what we're looking at is Apple at a discount? Right now, Apple is not at a discount. Apple is at an all-time high. So I am not going to make an all-time, or I'm not going to buy Apple for a long-term investment right now because it's at an all-time high. I would want for it to pull back at least to this 78.6 level, and ideally something closer to that 50% level. The issue with a stock like Apple, which is relatively strong, is that this doesn't tend to pull back a lot. So if you can get this for 20 to 40% to 50% off, that's probably as good as you're going to get on Apple because it's a really good company. You could probably say the same thing for Nvidia right now. So the better the company, the hotter it is, the less of a discount it's probably going to be. Like, when was the last time you saw a discount on the iPhone?
Never.
Never. So why? Because everybody wants it. So like things that people want don't get as discounted. So you might want to take a different approach where there's some stocks you can find seven that might hit a 70% off mark, an 80% off mark, but the really good ones, a lot of times you're rarely ever going to find them, 50%, more than 50% off at a discount. So then if a stock like this, if Apple gets down to 134, I'm gonna buy it. I'm loading the boat, right? I also like because of, the prior price movement, that seems to be the prior low. But if it ever gets down to 50% off, that's gonna be an amazing time for me to buy Apple, absent some crazy news that may or may not come out regarding the stock, over the next year or two or three, who knows what could happen. But um, so that's number one. Is it discounted? All right. And so just to look at something else, let's go to NVIDIA. All right. I don't have the fib levels on this chart. So just to show you how I would draw the fib levels, let me pull this over. I would go to this tool right here, the active tool, get the percentage tool, which is the Fibonacci retracements. Then start at the top, 140.6 is the high of NVIDIA. And the low is $3.68. So imagine if you would have bought Nvidia 5 years ago. You would have what? How much is that? Almost 40x, 40 to 50x your money.
Depending on how much you buy, you be a rich
Yep. So exactly. Oh, that was the last rule that I didn't put on my I guess that's more of a trade execution thing. So we'll talk about that at the end. Like when you said how much did you buy? So yes, this is how I would draw Fibonacci retracements on my chart. Start at the high over a 5 year month chart and then draw the low, right, which is $3.68. So when you're looking at Nvidia, like where would you potentially get in, especially post stock split, which is where we are right now. So I'm not going to buy it an all-time high here at 140.6, $140.76. And if you look at where we are right now, that would have been a terrible move to buy it at its all-time high because it's dropped, what, $14 cents. However, looking at this, how strong this is over the last, what, year and a half, Nvidia has not really had a significant retracement. So if you see this is one, once again, if you see it at what, 22% off, this is probably a good area where I would probably try to jump in, is at like 112. If you see it here at 90, even better. If you can catch it at 50% off, if it ever gets back down there, which I don't think it will, um, at least anytime soon, that would be the best place to grab it. If you could grab it around like 76 bucks, between 76 and $72, that would be amazing. But you see the way that it's gone parabolic, it's not even respecting these fib levels that much because it's gone parabolic. But just to show you, like, if this is discounted, that's why I would draw these retracement levels just to see if the stock is discounted or not. But you just never want to buy something at an all-time high. You're essentially you have FOMO. You think this thing is going to go to the moon. It may, but why would you ever buy something? The whole goal of any investment is to buy low and sell high. So why are you buying high to sell higher? Um, but yeah, wait for a pullback. So that's reason number one. In terms of like the things that I'm scanning for to get into a trade. Reason number two, does it have good fundamentals? I'm not just going to buy anything going up like GameStop or AMC, right? You'll see those have had their moments where they've gone up, but is that a good long-term investment? Absolutely not. Because if you go look at their earnings, they're absolutely terrible. If you go look at the debt, the cash on hand, the margins, whether it makes a lot of money, GameStop and AMC, they don't check any of those boxes for me anyway. And I've shown you before how I go to the website, go to the investor relations page, go actually pull their financials over the last couple of quarters. and go look at them. Go see, hey, does this look like a company that's growing? If we're taking like Apple again, like is there are their China sales growing? Did you hear news that their China sales are picking up? Are they picking up in India or somewhere else? Do we have a new cycle where everyone's going to buy the new iPhone because of the new AI features inside? So they're gonna sell more iPhones over this next cycle. Things of that nature. How much cash do they have? We've looked at how much cash Google has, how much cash Microsoft has just on hand, just sitting, how much cash Apple has, right? These are companies, even if we go in an economic downturn, it's not going to matter because they have so much cash on hand that they're going to be able to weather that storm or not borrow money and still be able to grow. Um, what are the margins? Like Nvidia has crazy margins, right? Their margins are like 80%. That's why they've grown so much, because they're keeping like 80 cents on every dollar that they make, versus companies like usually your grocery store type of companies, they have lower margins. And so you also got to compare like apples to apples and oranges to oranges, right? Costco, I think, is a phenomenal, a great company, but its margins are going to be way lower than Nvidia's margins. But that doesn't mean it's not a great company. What you're going to want to do is probably compare a Costco to a Target or to a Walmart or something that's very similar that's also doing well, or Home Depot, right? So like that's what I mean by the fundamentals. Like, does does the company seem like a company that's going to be around for a long time if this is a long-term investment? Does it seem like uh based upon the earnings, is it beating its earnings expectations? Is it beating consistently on the earnings per share? These are the things that you're looking at to see if a stock has good fundamentals. Um, yeah. All right. Number three, is it at an edge? So for me, I want to buy things, and this is for long-term investing or trading. I want to buy things close to support, and I want to sell things close to resistance. And you can buy to enter a trade or sell to enter a trade, depending on if you're shorting a stock or if you're taking it long. So I'm always trying to find things close to an edge because of the risk and reward nature of finding things close to an edge. So just to give you an example of that, and we use fib levels and moving averages. For me, those are what I consider edges. And so if we go back to Thinkorswim, let's go to that Google trade I'm still in right now. Oh, this chart's terrible. Okay, so we have this Google chart here. If I go to a day chart, I'm sure I could find the day that I entered. I enter right on one of these 2 days. Um, so without drawing the fib levels on this, which is what I usually would have done. In fact, let me do that again for you just to show you. So if the all-time high, in fact, we hit that on Friday, which is why I'm still in this trade. Bam, 50, 44. Okay, let's go to a 5-year day chart. Oh, yeah, this was perfect. This is literally a perfect setup for me. So this is what I mean by hitting an edge. So I got in on these 2 days because they were two confirmations for me. This would be like an A plus long-term setup for me. We hit a fib level on a really good company, on a really good stock in Google on these 2 days, and the 200 exponential moving average, the 200-day exponential moving average, which are my two like main indicators. So the fact that it was hitting both of these two indicators where I like to go long, Like this was like almost double confirmation, and I was extremely confident in this particular trade that it would bounce off of one or these two levels that were pretty much in the same exact area. Um, so just looking back, this is the reason why I entered the trade. It was twofold. It was a really good company. I looked up its earnings. It beat its earnings expectations, but it had went down because I think Microsoft or one of its competitors had done really well that quarter, and Google beat expectations, but not as much as like Microsoft or one of its competitors did. Um, it tanked for a minute, or it may have had like a bad Gemini or AI presentation. And then I saw it come down to that 200. I looked in the past and it bounced at that 200 before and it had been holding at this level right here before. And then that 200 and that 40% off, 39%, 38% off fib level was holding. So I got in right there. So that's what I mean at an edge. Like I caught it at an edge, which means, hey, I can get in around this 200-day moving average and this 61.8% fib level. And then I can keep like a tighter stop, maybe give it like $2 or $3 a wiggle, right? To like 128, something like that. Probably looking at the support right here. That's probably where I had my stop at the time, was right underneath 128, probably at like 127.50. And my goal at the time was to get this and swing it back up to the all-time high at that point in time, which was around 150. And if I would have took it from 131 approximately, 132 up to 152, that would have been $20 and maybe risking like $3, right? $3 or $4. So that was a really good risk reward scenario for me. So that's why I took the trade. But it's all about catching things at an edge. What I don't want to do is be taking that trade somewhere in the middle of a zone that's not near a moving average. Like imagine if I would have traded Google on this day, like, or let's say this day. That's even better because at least this one touched the top of this range here. If I would have traded Google on this day, what am I doing? I don't really have any confirmation. It's not near any of these moving averages here. It's not near a fib level here or really a fib level here. It's like in no man's land. So it's better to trade things. Even if I was to short this, I want to short it up here, not here. If I want to go long, I don't want to go long here. I want to go long here near an edge. All right. Before we move on, do you guys understand what I mean by like by trading things at an edge or near support or resistance?
Yes, sir.
Right. So that's the reason why you want your tools and your indicators, right? If you don't have your 200-day, your 50, your 34, your 21, some people use 100, like whatever your tools are, like if you don't have that on your chart, you're not going to know if it's near like resistance. Fib levels are like standard resistance, and moving averages are like dynamic moving resistances, where like this is going to change every day based upon the price levels, right? But your fib levels are going to be pretty much static until this breaks an all-time high, right? Then you got to redraw. But
So pretty much you're basing it off of the trajectory of the probability of what it will do next. So if you don't have your fib levels in place, then you're essentially gambling. It's more of a risk. Is that what you're
yeah,
saying?
yes, I'm looking at prior price action. That's the main thing that I'm looking at. Prior price action is included inside of these moving averages because it's averaging daily prices, right? So it's telling you, hey, at this average daily price, it tends to bounce off of this, right? If you're looking at the chart, it loves that 200-day moving average, right? Those were the best times to enter the stock over the last couple of years. It's when it's hit its 200 moving day average or a fib level right here, too. You know, those have been the best places to enter the stock. So I got a fib level and a moving average, a major moving average level to match up. That was a great setup for me. I could have lost that trade, but that was a higher probability setup because look at the discount. At the time, it went from 152 down to 130. It was already down like 20%. So, a 20% discount on a really good company like Google that makes billions and billions of dollars every quarter. I think it's in the $70 billion range every single quarter it brings in, and it's profitable, has a bunch in cash. Do any one of you think Google's not going to be around in 5 or 10 years?
Nope.
Yeah. So good company to buy at a reasonable price, at a good valuation. And this isn't necessarily what do they say, catching a falling knife. It wasn't the first day after the fall like it was here, right? This would have been catching the falling knife the first day after the fall. You let it come down, bounce up, come down, and then it hit a reasonable level where it tends to bounce. So that's where I entered the trade. And since then, man, like I said, that trade is up. It's been saving my short-term trading strategy. My long-term is up 4,400 bucks. And I bought two of those, one in my account, one in my wife's account. So I'm up 9 grand on that trade just by buying it at a discount to a certain extent. Number four, is it oversold? This is all about supply and demand, right? When supply is high, prices tend to come down. When demand is high, prices tend to go up. So have people sold a lot of this recently and demand's going to start picking back up because less people own the stock? Or like is demand picking back up, which means it's likely going to head back in the other direction? And so the two tools that I like to use for this is either the RSI tool, which is generally on almost every platform and free, or a slow stochastics tool. I purchased one of these through my class. It came with my class. There are, I believe, some standard slow stochastic tools, but I purchased one from a class that I'm taking. But I also use the RSI. This is probably the most basic indicator that everyone uses. It's the relative strength index. So if we go to our chart once again, so I have the RSI here. I do. Pull this up. So right here, let's use Google as an example again. So for me, I use like an extended level RSI, meaning the typical RSI is going to have these yellow lines at 70 and the bottom yellow line at 30. The top yellow line means that something is overbought, right? Overextended, meaning, hey, there's too many people with this. It's a hot stock. Chances are, like, look right here, when it was overbought, what did you see the next day? Stock fell, right? So that would have been a good indicator for you to, hey, maybe it's time for you to sell your position. If you had purchased it earlier, hey, looking at this over and it's super extended because it gets close to 80. Usually people consider something overbought when it's at 70. So if it gets close to 80, it's a really good idea for maybe you might want to take some profit off of the table if you're still in a position, right? Um, Same thing here, which is the one or two. I either bought it on this day or this day. It was oversold because it was at the bottom of this level. It didn't get down to 30, but typically if it gets down to 30, that's when it's oversold, where demand is likely going to start picking up. I like to put something at 20 because some rare occasions you will see a stock hit 20, and that's an even better setup for me because I'm like, oh man, this thing, everybody who wanted to sell this stock has already sold it if it's getting down to this 20 level. So this is a good time for me to enter, right? A lot of the crazy massive selling, the massive sell-off, that stuff usually happens up here. So by the time we get down here, this is probably a good indicator to buy it. And if you look at this, so it hit the 200-day moving average. It hit a fib level, and we were oversold. that was a trifecta for me to enter this trade, which is why I keep telling you this was an A+ setup for me. I rarely ever see a setup where all of these things are all coming together in one trade at the same time that are indicators for me that it's a good time to get into a trade. Feel me? Let's look at Dash because I'm pissed
Yep.
that I didn't get into this damn way. It popped on Friday. Um, Dash, just kind of looking. This is my target right now. I might sell a cash secure put on this thing on Monday. Because I really wanted at 110. I had a chance on Friday and I wasn't paying attention. Right there, hit it again. That's the level that I want. Look how long it's been consolidating. It's been consolidating for a month and a half, right here between 110.
I'm trying to get in that trade too, but it's hard at peaks right there.
Yeah, I know. And it hit it quick too, but like 110 is my level. And I missed it on Friday. I had it on a chance on Thursday and Friday. I missed it on both days. Right? It looks like once, twice, three, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 times it keeps bouncing off of that damn level. And this moving average is right below it, that 200. So for me, like I'm looking at this as an edge and this 200 as an edge. So the perfect time to buy this would be between these two edges and then putting a stop probably right below this edge right here. If it gets below, if this low of this day was 106.22, I'll probably put a stop at like 105.50 or something like that, right? Just below that edge. And I'm trying to catch it in here. And I think I'm trying to do a cash secure put on this because I told you the options aren't liquid on the leaps. So I can't buy this with the leap. I would have to buy shares. But since I'm waiting for it to hit this level, I think maybe a good idea would be to go into the option chain, get something that expires on Friday, and maybe sell what did I want it at? Is this oh, it's TLT. Hold on. Wrong stop. Dash. So I really want something at 110. Unfortunately, that's not that much money. So, I should have did this on Thursday or Friday when it got close to 110. Because I want this stock around 110, this is a way to sell a put on this to make $100 waiting for it to get there, right? So this is probably how I would try to enter this trade. I know we're kind of on a tangent, but I can make $100 waiting for this to hit that level that it keeps bouncing off of. And then worst case scenario, if I get assigned and it drops down to 109, I made $100. So really my entry price is if I sell this for 108, my entry price is really 109 because they're paying me $1 to sell this put, right? That's out to July 5th. I would prefer if that were more expensive or if it drops on Monday, that's probably what I'll do. If I see DoorDash is down on Monday, hopefully this moves closer to being in the money. Close to the money is like $1.50. So if that 110, let's say it drops a couple dollars, I'll probably sell a cash secure put on this to try and get assigned at 110. And I would be okay with getting assigned DoorDash at 110. If I'm just looking at this period of consolidation, that looks relatively safe for me, right? Um, it's not, and it's in the middle of this zone, so it's not particularly overbought or oversold, but this looks like a relatively safe zone for me to purchase if you just look at the chart over the last month and a half. It's pretty much stayed there, even the weekly chart, right? That 110 level, it seems to just be bouncing off of consistently. Reason number five, this is more so for long-term investing, not for short-term investing or trading. Does it have a moat, right? We were talking about Apple, the iPhone, right? They only have one competitor, it's Google, so the Android platform. And it's not really Google, it's like people that manufacture Google platform devices like Samsung, Google's Pixel, they're trying to do it themselves, but like Samsung and a lot of other different models of phones, that use the Android platform. So Apple has a moat in that space, right? Most people who have an iPhone have had an iPhone for the last 4, 5, 6 models, don't intend on switching. They love their iPhone. All of their friends have iPhones, so this is how they communicate. So it has a moat. Nvidia right now with their chips, with their AI chips, they have a moat. They're number one in the sector, right? AMD is trying to compete, but every time AMD has a new chip, Nvidia has a newer, and more advanced chip that's better than AMD's. And they also have a bigger developer space for their CUDA software. And so there are more developers developing things on their chips, and their chips are faster and they're more expensive, and NVIDIA has 30% of TSM's manufacturing capacity. So really, it's going to be hard to compete with NVIDIA. So it has a moat. That's why it's number one in the sector. So I'm looking for companies like that, even Shopify, who I have a leap in right now. I think they're the best e-commerce platform right now. And that's for me using WooCommerce. I also use Square for the book fair company. And then after researching and using all of these companies, I'm deciding to go with Shopify because it seems to me that they're the best in the sector. They're the leading company in the sector. It seems like all of the biggest companies like Meta and Twitter and TikTok are all partnering with Shopify to have easy integration to sell products on the social media websites. So I like Shopify. That's why I'm buying it. DoorDash, same thing. It's between them and Uber Eats, right? Between the delivery companies for food. They're number one or number two in the sector. Airbnb, it's either them or hotels, right? And Airbnb almost created its own sector. Home Depot, it's them or Lowe's. Uh, Apple or Microsoft, right? So these are that's what I'm so when I'm investing long term, I'm looking for companies that I believe like have an unfair advantage in their particular sector, even if it's like a subsector within a sector, right? Because like Qualcomm potentially it does chips, but it's more for mobile phones rather than for, like Nvidia is not really doing mobile phone type of chips. It's doing chips to power cloud-based services, crypto, and AI, large language model companies who are building large language models or building companies off large language models, right? So does it have a moat? So when you're just thinking about what you're buying, like that's how you can determine if it's going to be around over the next 5 years. Is there somebody doing it better? Uh, will it be easy to compete with it in the space? Right? It's not going to be easy to build another Shopify. It's not going to be easy to build another Apple. It's not going to be easy to build another Nvidia and compete with it. It's not going to be easy to build another TSM or ASML. Um, so is it going to be easy to compete with that company? If it's going to be easier to compete, I'm less likely to buy it long term, right? So the sixth and final reason is like, what is the index or the sector doing, right? If you look at the entire chip sector right now, it's up. So if you see a pullback on NVIDIA or AMD or Qualcomm or something decent, ASML or TSM in the space, then I'm going to be more confident taking that trade because the whole sector is up, right? Is the Nasdaq on a tear? Is the Dow on a tear? If the Dow's on a tear, then energy is probably going to look better. Financials are going to look better. And just kind of understanding how the indexes and the sectors affect the stocks within them. So, like, if the Nasdaq is down, which then that means probably QQQ is down, and then if QQQ is down, that probably means Apple and or Microsoft are down because they're the most heavily weighted in the sector. So it's just like understanding, hey, if the whole sector is trending downward, maybe I need to wait till I see some consolidation, like what we just showed on DoorDash, right? We saw a month and a half worth of consolidation, which indicates like, hey, maybe the sector is getting ready to reverse or turn around. And if the sector is getting ready to reverse, if QQQ is getting ready to reverse, guess what else is probably going to be reversing? Apple and Microsoft. because they're the most heavily weighted in the sector. If SMH is consolidating and looking like it's going to reverse, which is the semiconductor ETF, guess what? You're probably going to see Nvidia, AMD, and Qualcomm reverse as well if they were in a downtrend. So just understanding how the indexes and the sectors are working, and then so if you see the Nasdaq up and SMH down, and SMH the chips are a big component of the Nasdaq, you don't have a lot of clarity. You don't really know what's going to happen because you got the tech sector up, but a big component of tech is down. That's not a lot of clarity. So maybe you should wait until you have more clarity, depending on what your strategy is, right? So just looking and understanding like how the indexes and the sectors are built within the index, like is going to save you a lot of a headache and just kind of understanding like where the trends in the market are going or for that particular sector, or understanding that DoorDash, like a company like DoorDash, isn't heavily weighted in any sector or any ETF, so it might be capable of doing its own thing, right? Versus Google, Google is heavily weighted in XLC, the communication sector. So XLC is really the most heavily weighted names in the XLC or the communication sector is going to be Meta, Google, Netflix, and then maybe Disney. So in terms of understanding, hey, if XLC is on a trend upward, then likely Meta, Google, Disney, and Netflix, if those are down, have a good chance of reversing to the upside because their sector is heading up too, right? That makes sense?
Yeah.
Right. So really understanding that, and so I can kind of show you guys, I've done this before. So let's say XLC, since we're talking about that. If I want to know what's in XLC, I can go look up one of these State Street websites or sector spdrs.com. It's really good, right? Click on one of those and you scroll down, it'll tell you what it holds. And as you can see, and because I've done this, I know that Meta and Alphabet or Google are the most heavily weighted names in XLC. In fact, Google is more heavily weighted because it has two different tickers, but if you combine those, that's 26%. So Google is the most heavily weighted name in XLC. Meta is number two. Netflix is number three. You got T-Mobile, Disney. The reason I don't usually like trading any of the phone names, that's why I said Disney, but I know Disney is usually higher up. It's almost 4%, right? But the top three names, Meta, Google, Netflix, right? So if these three names are up on a day, I can almost guarantee you that XLC is going to be up. If these three names are down, I can almost guarantee you that XLC is going to be down. And then this is kind of just what I'm showing. So let's say I want to trade Disney, and I know that Disney is a decent sized component in XLC. If I see on that day that Meta is down, that Alphabet is down, and Netflix is down, I am not going to be trading Disney to the upside because Disney is a component in XLC. So when people buy XLC, they're buying Disney, right? So if people are selling off XLC or selling off these names within XLC, then XLC is going to go down. So that day, I am not going to be taking Disney to the upside. Conversely, if all of these names are up, Disney is going to have to work less hard to go up. So that's going to be a good day for me to take Disney to the upside. If XLC is up, all the names in XLC is up, that sector is up, Disney is likely to do better that day. Let's take XLK, which is the tech sector. If you look at XLK, that a lot of people trade, go to the holdings. Top names, Microsoft and Apple. Nvidia is climbing up there, right? So if Microsoft and Apple are down, guess what's going to be down? Probably the entire tech sector. Because people who are just buying ETFs to own Microsoft and all of these companies, If Microsoft and Apple are down that day, that's like 43% of the major tech ETF that everyone buys. So if those two are down, it's going to be very hard for tech to go up that day. So yes, there's a chance that AMD could outperform or Adobe could outperform, but is it probable? No. So I'm really trading and investing on probabilities. So if Microsoft and Apple are killing it that day, that's going to lift all of these too. If Microsoft and Apple are down that day, that's going to pull a lot of these names down, most likely. Some of these, like Nvidia, kind of has its own story, but like specifically, if these three are down, all tech is going to be down or likely going to be bearish that day. Yes, you could have an Oracle or something doing its own thing for one day, maybe because of some news, but that would be a low probability trade for you to uh, enter into a tech trade when the three most heavily weighted names in the tech sector are down that day. Okay, so that was reason number 6. Like, what is the index and the sector doing? Like, are they like incongruence? Are they showing a reversal trend as well, which might give you some more confidence that the stock within the index or the sector is going to reverse too? Are they in an uptrend and pulling back just like your sector or your stock? So they seem to be in congruence, or is your stock doing the exact opposite of what the index and sector is doing? Tesla does that a lot. Tesla trades on its own. Its major weighting is in XLY. So, and the other major weighting in XLY is Amazon. So if Tesla and Amazon are up, then that's usually a good thing for both of those two stocks, just because the ETF is going to be up too. And when people are buying the ETF of XOY, they're buying Tesla and Amazon. Right? So those are the top 6 reasons why I enter a long-term investment or a trade, specifically on the investment side, which is also a trade, but it's just more of a longer term trade. Um, Oops, I forgot to add number 6. Number 1, is it discounted? Number 2, are there good fundamentals? Number 3, is it at an edge? Number 4, is it overbought or is it oversold? Number 5, does it have a moat? And number 6, index slash sector. Is it like incongruence with the index or sector, moving opposite of the index or sector, and just understanding how it's weighted inside a lot of these ETFs and index funds that drive the market? All right, we got 10 minutes left. Anybody want to look at anything? Have any questions about like my long-term strategy?
I like this Zoom meeting. It was pretty good. This one was one of your best ones so far. I like it. I like it.
Thank you. I appreciate it.
Um, we
Yeah,
can
it's
look at some.
crazy. Sometimes when people tell you, like, hey, can you give me your rules? And you're like, maybe I should go and write down my rules.
I still got the rules you gave me from when we started this whole thing.
Yeah, those are more so. So I do have those that was for the wheel strategy using cash secured puts and selling calls. I like that when the market is down, right? Where the market is down and then you're like, I don't know if this is gonna go lower, and everyone's kind of scared. When I was doing the wheel strategy, selling cash secured puts, it was mostly like, hey, all of these stocks are discounted right now because the market was bearish. We were in a bear market. And when we're in a bear market, people always are fearful that things are going to fall lower. And so using a cash secured put strategy and selling covered calls is a good way to generate cash waiting for things to fall lower. Or if they don't fall lower, you're going to make more money. You're going to make money just off, getting premium. So right now we're at all-time highs. I am not trying to pick up a lot of stocks that aren't heavily discounted when we're at all-time highs. So I'm chilling on that will strategy with the exception of something like a DoorDash or an Airbnb that we've been watching that are discounted in this bull market that we are in. So I'm not using it on as many stocks as I was using it on when we were in a bear market where I'm like, hey, everything is discounted, but I'm not sure if everything's gonna fall a little bit more. So let me at least make $100, $200 if this thing falls to a level where I think it's probably gonna hit one of these fibs or hit a lower moving average or something like that. Um, and right now, since everything's like near all-time highs, at least the stocks that I'm interested in, that strategy is not something I'm going to employ until we see like a huge market correction where everything falls. If I see everything falling, then I'm probably going to start employing that will strategy a lot more. But
Nice, nice.
any particular names anybody want to go over?
No, I want to see the video one more time because I'm on a long call on that one. I want to see what you got to say about that one.
So I did draw the fib level already. Let's go to the day chart. Looking at the day chart from a trading standpoint, I
Yeah,
like I like this 120 level right here.
yeah, 120 up. I've seen it
I like it because it's
time. I
strong.
think again.
This is the 21-day moving average, right? Nvidia is usually pretty strong and has been and doesn't pull back a ton. But it has been, if you look at here, there's 21 bouncing off of here. And this is for trading. This is not for long-term investment or a leap. But for trading, that 21 has been a good level that it's been respecting. Here you saw a dip underneath, right? This was kind of like the aberration right here. But like up here, it's been responding pretty well to that 21. So if I were, and 120 is a nice round number. And stocks tend to reverse and have resistance at nice round numbers. So if you look at 120, right? And even around here, you had a closing price around 121. You had a closing price here at 120, around 121, a closing price here. Um, yeah, I really like this like 120 level. If I could Nvidia for either a short-term swing or a day trade, specifically a swing, if it gets down to 120, that's where I really like it. And if you look at this here, the RSI that we were talking about, when we got up to this high, it was, look, it's overbought. It's close to this high. And this is where I was saying it's a perfect example. My RSI is at extremes. I have it at 80 and 20 versus 70 and 30. And this one got above 80. So when it got above 80 right there, then it had one more day in it and then it dropped. So what I'm waiting for this to do is look, I want this to get further down and look more oversold. And I think when we hit that 120 level, it's gonna get further down, at least below 50. And a really good level to hit this at would be right here because look at the fib level and the moving day average are lining up. So this 34 right here, if you can catch it at like 112, if it even gets down there, 112 to what? 111, 110. That's another good area to pick it up for a trade. Just looking at the chart. And then you look over here, there's some more support. Where was this close at like 110, 109.63 is this close? So yeah, this would be this range from this moving average to this fib level seem like a good place to pick it up. And if you want to be more aggressive on it, because you don't think it's ever going to get down here, I would try to pick it up for a trade at 120 and keep a stop at like 118, 117.75.
Good game. What about can we see when's the next speaking or earnings and information that they're going to be talking about on the
For
semiconductor the video?
Well,
Are you
we're out of earnings season right now, so Nvidia is not going to be reporting earnings for at least another 2, 3 months.
got it?
So what is it? A Market Watch calendar? Yeah,
What's
Nvidia.
IBM looking like?
Oh man, I don't even want to look at that damn stock, but sure, let's look at it. I look, the reason why, look, I wouldn't, maybe I would trade IBM long-term investment though. Look at what it's done over the last 5 years. So let's say you picked it up 5 years ago for 133, it's at 172. So you made what, $40? That's not a great return versus like what we saw Nvidia do, what we see Apple do, what we see Microsoft do. And then my biggest issue at IBM is this. It's like one of the factors that we talked about. What moat does IBM have? That's the question, DeAndre. What moat does IBM have? What does it do better than any other company? What other is it in the top one or two of its sector? What does it do better?
That
They're
tells it right
not.
there.
Right? When
Yeah,
was the last time you bought when was the last time
they're
you bought an
not. They're
IBM
not.
product? When was the last time you bought an IBM product?
Well played.
When was the last time you know somebody that's bought an IBM product?
But they're making semiconductors, aren't they?
Maybe, but
What would they what would they be in the space?
are
There's
they
number
making
one.
are they making
IBM would
semiconductors?
be
But see, so even if they're in the semiconductor space, I'm not sure if they are in the semiconductor space, but they're kind of trying to get in. They're in like um, um, the business computing, like solution type of space, right? If you need a hardware solution or servers and stuff like that, that's my understanding what IBM does, right? Oracle does that way better than them. And if I were to trade anything, look at Oracle. I would trade that. Look at that stock. That looks way better than IBM's chart. Microsoft does a lot of solutions for companies and business. Looks way better than IBM's chart.
yeah. All
Um,
right, let's look at Salesforce.
CRM. Actually, I have been looking at them recently. So, in fact, I have an alert on. If Salesforce gets to 213.20, I want it. That's what I have been looking at this. So because I missed it right here. So that's Salesforce. I do think, and I do well, it missed on its last guidance. I think it either met its earnings or kind of beat earnings expectations on its last earnings period, but it guided a little bit lower. So that's why you see this drop right here. But I like CRM. This is the number one in the space. Number two is HubSpot.
Is HubSpot.
Yep. So these two, but if you look at this looks like a better company from a 5 year standpoint. It hit a high, came down, but it's been trending upward lately. And I can tell I've been looking at it because I already got the fib levels drawn. If I already got fib levels drawn, that means I've been looking at these companies. Like these are the top two in the space. CRM is the most discounted right now. Let's go draw the fib on this. And hit an all-time high rather recently, which is what I like. 115. 318.70, or no, 318.17. And then the low is, what was it, 115.29. All right, so here are the fib levels for Salesforce. Um, like I said, I drew a level at 213.20 a while back, and I'm trying to figure out why I drew it at that particular level or something around here is when I wanted to alert me. I think it's because of this 50-month moving average. It's been bouncing off of that, so I have it there. If we go look at a weekly time period, oh, it's hitting that 200-week moving average right there. And I'm mostly just looking for alignment. And if we go look at a daily chart, that looks like it was around a low. And it's right around that 50% fib, right? So it was 50% off. I should have bought it on this day, but that would have been catching a falling knife, right? If we look, I think that was the day after earnings where it guided lower for the next quarter. That would have been catching a falling knife. So I looked at it after that, but this looks like good resistance. And look at this RSI here. That I should have bought it that damn day. Look, it's at 20, it's at 18. And I told you if it gets below 20, it's super oversold. That's an indicator to hop into a trade. But me, I usually don't like to grab anything for more than like the day after earnings. I'm gonna wait a day or two. But I like that 213.20 level. I think it was drawn for
That
me.
was a discount.
Yeah. I think it was drawn for me based upon it looks like there's some support right here where old resistance or equals new support. This looked like it was a good resistance level here in the past on the monthly chart. Even right here with this little candle, and then right here it bounced off of, and then it's next to a 50-month moving average. So and a fib level. So this is a good zone, was between like 216, 217, and 213. That's kind of what I'm waiting for on Salesforce. If it pulls back there, I like it. If you're more aggressive, you could grab it somewhere up here, but I just don't see maybe at 240 if it pulls back to 240. That's more of an aggressive, but one, two, it only really obeyed that fib level like twice. So I don't know. But I like it if it's 50% off. I think Salesforce is a decent stock. We go look at the earnings a little bit. It missed on revenue barely, which is why I said it, and it beat on its earnings per share and barely missed on revenue, and it's bringing in $9 billion of revenue. Like I just like it looks like a company that is making money. So we go CRM, investor relations. So this is what I'm saying that how do I look at the fundamentals of a company? I'll go look at like what it made, go look at the financials. If it's publicly traded, it has to report its financials. So just looking at the quarterly filings, I don't know why it says 2020. Are we in 20? All right, go look at the financial statements. Right, look at the revenues. Look at last year. This is exactly so in terms of finding value, even though it reported that its next quarter wasn't going to be so great, look at the growth. It grew its revenue by almost $1 billion from last year, right? From the quarter to quarter. This is just for a quarter. So that looks good to me. The gross profit is up, which is always great. The subscriptions, or no, that's the expenses, right? Let me just look at income is up. It made 412 million in profit. Now it's making 1.7 billion in profit. So I like that. For me, this looks like a company with a good balance sheet. It looks healthy. It's number one in the CRM space. It's doing well. So that's why it's on my target list. Why I have an alert already set where if this thing drops to this price, I'm probably going to go buy a leap. And I assume that Salesforce leaps are more liquid. So if we go out to June or January and look at the open interest, actually, they aren't that liquid. Let me go out a little further. You know what they say about making assumptions. Ah, actually, I would have probably have to take these with shares too, because the leaps on Salesforce are terrible. I would have to, yeah, I would. Let's see if we go out to 2026. No, I don't know. Either that or I would have to break my rule regarding liquidity. And I would more likely get this one because at least this has the most liquidity here at 419. So if I were to buy Salesforce, I'd buy this 200 strike. But just knowing me, I probably would buy shares of this because I don't like the liquidity in the option chain. Even this one, it's too close to the money. This is the most liquid. this would be the safest option to buy, but I typically like to buy something with a delta that's like at least 85 or better. The higher the better, but I don't see any liquidity at those strikes. All right, fellas. Anything else? Anything else anybody want to look at?
Good meeting, man. Good meeting.
Yeah, appreciate it, man.
Appreciate you.
All right, folks. That's Mocama Sunday service. Until the next one next week. Oh, before we dial off, anybody have any topics for next week?
I think it's gonna send you a message. I'm not off the top of the head.
Okay.
What goes all into the research for stock?
I kind of just showed you it, and so it depends on like so we'll talk about this. It's like the difference between fundamentals and technicals. Fundamentals are
Yep.
what we just looked at in terms of go look at the balance sheet of the company. Don't just look at the stock price. Is this company actually making money? Is it growing revenues? I just showed you and with empirical proof that CRM or Salesforce grew its revenue from last quarter to this quarter, right? That's empirical proof. It's growing revenue. So that means that it's going to be a healthier company. It's making money, it's making a net profit, its net profits are going up. I didn't look at its margins, but look at the margins. Are its margins growing? Is it similar to other companies in the space or better than other companies in the space? And then once you are satisfied from a long-term investment standpoint that this is a company that's probably going to be around for the next 5 to 10 years and is going to keep growing revenue because you looked at its books, then go look at the stock price. That's the technical analysis. Is this discounted? Is it near an edge? Is it oversold? Is it overbought? And that's really the two-pronged approach. Is it fundamentally sound? And then do the technicals suggest that this is a good time to enter into the stock? But yeah, we'll save that for next week. We can go in that to into more depth, but that's pretty much my approach from like a long-term leap standpoint or a long-term investment standpoint. Fundamentally, is it sound? Technically, is it sound? And then enter in the trade. What's the best place to enter the trade? All right, y'all have a good Sunday. I'll see y'all next week. Peace.
Appreciate you, boss.
You